And here's warning sign number 4. All they offer are mutual funds and annuities. I mean, if your portfolio looks like it was pulled straight out of a brochure, that's a sales brochure, with loaded mutual funds, could be an A, B, or C share, maybe a few annuities, maybe if you're lucky, a target date fund or two, it's probably time to take a closer look at who's managing your money. Now, here's why this all matters. I mean, mutual funds and annuities, they're not inherently terrible, but when they're the only tools your advisor uses, that is a massive red flag, especially if you've got millions invested with them. Now, here's what cookie cutter actually looks like. If you give your advisor $3, $5, $10 million or whatever it might be to manage, and you get a few actively managed mutual funds, you get an annuity with a 10-year surrender period, which means you can't take the money out within 10 years without paying some sort of a penalty. If you have some sort of a model portfolio that's rebalanced a couple times a year that everybody in that firm owns, whether they have $100,000 or $100 million, that's not customized. That's commoditized. You're probably overpaying you're overpaying for under delivery. You're not getting what you should be getting, and that is a problem, and that's why you've likely outgrown cookie cutter advice. Now, at your level, here's what sophisticated investors use. Your investment strategy should include some direct indexing. I mean, it doesn't hurt to have some exposure to the S&P 500 or the NASDAQ. Maybe there's some customized ETF models with possibly some thematic ETFs that you want to participate in, whether it's maybe a health and wellness theme that piggybacks off the GLP-1 Ozempic kind of craze that's out there right now. Maybe it's an AI, artificial intelligence related theme, but some of those customized ETF models could be good fits for you. You certainly should have some exposure to individual stocks. And for some people, maybe that's almost all of their portfolio. For others, it could be a small percentage, but nonetheless, you should have that somehow, some way intertwined into your overall investment strategy. You should have tax-aware rebalancing. That ensures that just because an advisor might have a software that auto-rebalances every single quarter, that you're not selling things at the wrong time and actually triggering short-term capital gains. I mean, long-term capital gains, when you trigger those, that's bad enough, but short-term capital gains are taxed at a much higher rate. So the rebalancing actually typically needs some human interaction to ensure that there is tax awareness going on there. And then risk management aligned with estate and tax plans. You need to make sure that for all the risks that may exist out there, you have to do everything you can to do your best to not eliminate those risks, because they can't be completely eliminated, but you need to do everything possible to mitigate them so that if one of those events happens, it doesn't completely sabotage everything you've grown. Your portfolio should be engineered, constantly tweaked, not just assembled and handed to you. So let's take a look at what the research says. Vanguard says advisors add value through tax-efficient portfolio construction, not just by picking investments, but by actually optimizing them across account types. Bonds, as an example, they throw off taxable interest. If you feel like as part of your portfolio you should own bonds, wouldn't it make more sense to own a bond in a place where there's some tax advantage? I mean, I know I wouldn't want to own a bond in a non-qualified account where every time that bond pays interest, I pay ordinary income tax on it. I would rather shelter that maybe in my IRA or some other location where I can get some tax deferral. Similarly, if you own a stock that is a high growth stock that maybe doesn't even pay a dividend yet because it's such a growth stock, you can own that in a non-qualified account with no tax advantage. Great thing about that is there's no income tax on anything you get from that stock. In fact, when you sell it, assuming it's at least 12 months later, you're going to pay the much lower capital gains rate only on the appreciation that you experience. And most advisors build the same portfolio for pretty much everyone. And at your level, you deserve more than that. And you actually need more than that because of the way accounts are set up across the different tax wrappers that we've discussed. Tax advantage like IRAs, tax deferred accounts, tax-free like Roth IRAs, and again, non-qualified accounts which have no tax advantage at all. So let's explore some of the hidden costs here. A lot of mutual funds have very high internal fees that quite frankly are unnecessary because 80% of them underperform like a low-cost ETF anyways. Many annuities come with big commissions, could be 5%. I've seen some as high as 10%, and they come with lockups, periods of time where you can't actually get your principal back. Model portfolios are often managed by someone you've never met, and you're getting less flexibility that way, you're getting less tax efficiency, and believe it or not, you're actually paying more for a lesser service. Not good. Does your portfolio reflect your goals, values, and tax situation? Or does it look more like a cookie cutter template? Now, if it's the latter, you've probably outgrown your advisor. We build strategies around your entire financial picture. If you're interested, go to tepperzoom.com and book a 30-minute Zoom with me. We can then talk about whether or not it might make sense for someone from our team to build out a confidential wealth strategy audit for you so you can see what you're doing well, where you might need some improvement, and what we might be able to help you with to close that gap.